Welcome. In this video, you'll learn what chart patterns are and why they matter in trading, the three main types of patterns: reversal, continuation, and bilateral, why chart patterns work, and the psychology behind them, common mistakes beginners make when trading patterns, how to start positioning yourself to use them effectively. If by the end of this video you learn something, be sure to hit that like and subscribe button and turn on that notification bell so you never miss a new upload. You've just heard what we're covering: chart patterns, the psychology behind them, and how to avoid beginner mistakes. But before we break those down, let's step into the shoes of a new trader. When you first open a chart, it feels like complete chaos. Red and green candles shooting up and down, no clear meaning. Over time, though, you start noticing certain shapes and movements repeating again and again. These repeating structures are called chart patterns, and they're one of the first tools traders use to make sense of the market. They reveal the ongoing battle between buyers and sellers, when momentum is building, when it's stalling, and when a reversal might be near. This video isn't about memorizing every single pattern just yet. Instead, it's about giving you a beginner-friendly overview of the three main categories, why they matter, and how they bring structure to what once looked like random price movement. The three types of chart patterns. Every chart pattern you'll see can be grouped into one of three main categories: reversal, continuation, and bilateral. A reversal pattern tells you the current trend may be coming to an end, and a new one could be forming. Classic examples include the head and shoulders, where the market forms a peak, a higher peak, and then fails to make a new high, or the double top and double bottom, where price tests a level twice but fails to break through. A continuation pattern suggests that the trend is taking a quick breather, but is likely to resume in the same direction. Think of flags, pennants, and triangles. They represent consolidation phases where buyers and sellers balance out temporarily before momentum continues. Finally, a bilateral pattern signals indecision, showing that price could break in either direction depending on which side gains control. These patterns, like symmetrical triangles, are especially important because they force you to think in probabilities rather than absolutes. Learning to instantly recognize whether the market is hinting at a reversal, continuation, or indecision gives you a mental framework. Instead of feeling overwhelmed by what looks like random candle movement, you'll be able to filter the noise and make logical, structured decisions. Over time, that shift from emotional reactions to clear analysis is what separates beginners from disciplined traders. Why chart patterns work and their hidden trap. Chart patterns aren't magic. They work because they reflect human behavior. Every move on the chart is the result of emotions: fear, greed, hesitation, and overconfidence. When traders pile into a trend, momentum eventually slows as people start taking profits. That's when a reversal pattern can form. When the market pauses, waiting for more information, price often compresses into consolidation or continuation patterns before breaking out. But here's the catch. Because patterns are so popular, they can also become traps. Institutions know retail traders are waiting for the obvious breakout. They'll often fake the move in one direction, then reverse it sharply the other way. This is why you should never trade patterns in isolation. A pattern is just one piece of the puzzle. To use them effectively, combine them with context. Things like support and resistance, volume and timing. That way, you're not just memorizing shapes, you're trading with a full picture. Pause for a second. How's this clicking so far? If it's starting to connect, hit that like button. And if you're ready for more insights like this, subscribe before you forget. The psychology behind patterns. At the core, chart patterns work because they reflect psychology. A double top forms because buyers keep failing at the same level. A flag forms because traders are taking profits but not exiting the overall trend. Every line and shape is really just a picture of emotion: fear, greed, hesitation, and confidence. Once you stop seeing patterns as shapes and start seeing them as stories, your trading changes. The next time you spot a head and shoulders, don't just think, that means reversal. Instead, ask yourself, why are buyers giving up here? Why are sellers stepping in now? Understanding that story will always give you more confidence than simply memorizing patterns. And that shift, from shapes to psychology, is what separates casual traders from serious ones. Common mistakes beginners make. Most traders fall into the same traps when starting out with chart patterns, and knowing these ahead of time can save you from costly lessons. The first is pattern hunting, seeing shapes everywhere and forcing trades just because a few candles look like something out of a textbook. Markets are messy, and not every zigzag is a signal. The second mistake is ignoring context. A triangle that forms in the middle of a random trend carries far less weight than the same triangle forming at a well-tested support or resistance level. Without context, a pattern is just noise. The third mistake is jumping in too early. A pattern isn't valid until a breakout or breakdown confirms it. Acting too soon is basically guessing, and guessing isn't trading. Finally, beginners often forget risk management, loading up too heavy on one perfect-looking setup because they think they've cracked the code. Even textbook patterns fail, and if you overexpose yourself, one loss can wipe out weeks of progress. The truth is, success comes less from spotting shapes and more from combining patience, context, and discipline. Time frames and chart patterns. One of the biggest mistakes new traders make is treating every pattern as equal, no matter where it shows up. But a flag on the 1-minute chart is not the same as a flag on the daily chart. Shorter time frames often carry more noise, random movements driven by bots, scalpers, or news spikes. These patterns may play out quickly, but are less reliable because they reflect short-term emotion rather than sustained behavior. Higher time frames, like the 4-hour or daily charts, filter out much of that noise. Patterns that form there usually attract more attention and follow-through because bigger traders, institutions, funds, and swing traders are watching them. That doesn't mean lower time frames are useless. They can still be powerful for quick entries and exits, but always keep the bigger picture in mind. A bull flag that lines up with a daily trend carries far more weight than one floating in the middle of a noisy intraday chart. Understanding this difference is what allows you to separate high-quality setups from distractions. Pattern mastery through journaling. One of the most effective ways to truly learn chart patterns isn't by risking money right away, it's by journaling. Instead of rushing into trades with real capital, start by opening a demo account or simply screenshotting charts. Each time you spot a potential pattern, circle it, label it, and record what happens next. Did the breakout succeed? Did it fail? How far did the move go before stalling? Over time, you'll build a personal database of examples that show you which patterns actually work best for your style, in which markets, and even at which times of day. This process doesn't just sharpen your eye, it builds trust in your own analysis. When you've seen a head and shoulders play out dozens of times in your journal, you approach the real trade with confidence because you know the probabilities, not just the theory. Think of it like training muscle memory. Repetition makes spotting setups second nature. The more you journal, the more automatic it becomes to recognize real opportunities without hesitation. That's your introduction to chart patterns. You now know what they are, why they matter, and the 3 main types to look for on any chart. You've also seen how psychology creates them, the common mistakes beginners make, and how you can start practicing without risking real money. In future videos, we'll break down specific patterns one by one, and I'll show you exactly how to spot them, avoid common traps, and use them as part of a trading system. Thanks for watching. If you found value in this, be sure to like the video and subscribe to the channel for more in-depth trading insights and strategy breakdowns.